Zach Wiegert, welcome. Thank you for spending a few minutes with me today to better educate me and our clients on goldenrod. Um, Zach, why don't you give just a little bit of background kind of on you, how you got started in the real estate business, and then I'll have some follow-up questions.
Sure. Yeah, I played on college at Nebraska. I know you know that, and we talked about that quite a bit. And I played professional football for 12 years, and then about my second year playing professional football, it's one of those sports is one injury could be the end of your career doing that. So I started doing real estate development and was fortunate. At the time, I had my own money to invest alongside others, and got with a company from Salt Lake City, a large family company. I learned a lot about the business. And then in '07, when I retired from the NFL, started my own company. And then most recently here in 2017, managed three closed-end real estate funds.
So we're fortunate enough to be, as you know, participating in the last fund. Tell 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 us a little bit about how you all do it a little more uniquely, maybe than the next firm down the street.
Yeah, I think we look at it differently. A lot of the firms that go after the pension plans and the really large funds that do what we do, those funds are looking to build their own portfolio. I mean, we're really set up to be an investment for an RIA, for an individual. And the reason that is we build each fund as its own portfolio. So we diversify by, location, asset type. We do acquisition and development. And so every fund is its own unique portfolio. So any investment in any fund, you would have exposure to a different city, a different product type, value creation through development, and cash flow through acquisition, all in each fund. So that's very different from how the $2 billion type funds run their businesses.
Well, one of the things that was appealing to us when we went through our due diligence with you was that the funds were typically smaller in size and occurred more frequently, which
Mhm.
in our view meant you probably could be a little more nimble in how you deployed those assets and weren't stuck to a certain framework that I think some of the larger funds maybe are forced to stick to.
Right. Well, the thing that's been great is, we started our first fund in 17. And so our first fund was a pretty normal time. And then our second fund was in 19 when COVID hits. So a completely different market. And then now our third fund is we're seeing high inflation, higher interest rates, and all that. So just for an example, those three funds are all strategically completely different of how they're looking at the market. And so, a fund where you're forced to put out $2 billion at a time, one, they get very lazy because they don't want to do deals unless you're putting 150, $200 million to work at a time, because it's just more for them to manage. Our average equity investment is about 12 million per project. So you get a diverse portfolio. You're not putting all your eggs in one basket, but yet we're very nimble and we react very quickly to what the market is doing. Every fund has, hey, here's generally the strategy we have, but that can turn at any time. The market can, just like we've seen recently. So,
Uh, Explain how you think about geographically where you think the value is in the
all
country.
right. Yeah, so we're central U.S. focused, and part of it is those are the markets we know best. I mean, we're based out of Omaha, Nebraska, have offices in Fort Collins, Dallas, and Atlanta. So we pretty much triangulate the central part of the United States, but we pretty much say Salt Lake City, Atlanta, Omaha to Houston. And the reasons for that is one, location, two, price of assets. You're in markets where you can buy at much better cap rates than the coastal markets. And a lot of that is just because you don't have nearly the amount of foreign money coming in that wants a 2 or 3% return. So you're not competing with these groups that are not looking for returns that I suppose your investor group would like to see. So that's a big part of it. And then also, as recently as well, we keep getting proven correctly because with COVID and all that, there's just a mass exodus from the coast into the regions where we've always focused our business.
Right.
So very, very stable, very business friendly. All the MSAs we do business are very business friendly. They don't put on tons of regulations and add extra costs and make it hard to get things done. And I mean, that's just kind of always where we've done business and been successful doing it.
Tell me a little bit about your target returns and kind of in a perfect world, how you get to that return.
Yeah, it's pretty simple. So we say 18 into an 18 gross IRR and a 2 multiple. And I don't know what your audience knows about that, but one is an IRR is just a measurement of time. If you make $1 the day after you invest $1, you 1,000 IRR, right? And if you make that same dollar back over 10 years, the IRR is terrible. So you have to calculate both time the money's been invested and the whole dollar is coming back, and that's what the multiple measures. So that's how we always say it, is both time and multiple are important. Basically, how we get there very simply is, and I can share with any of your folks, and I'm sure I've shared with you, is we have kind of a matrix we put together and said, hey, if you buy something at a 7.5 cap in the central US, which we're buying at above that now, our whole portfolio is at 806 cap rate for all 3 funds combined. If you buy at a 7.5 cap, you borrow at 5.5%. You hold it for 5 years and sell it at the exact same cap rate. You don't need any cap rate compression. You make an 18 and a 2. So it's a pretty simple business model. I'm not going to say I have a crystal ball and say, hey, this thing's going to go up so much in value just because cap rates are going to change. But I do know that if I pay down debt and have cash flow the whole time, I can get to an 18 and 2.
Well, it's been interesting as I've been fortunate enough to be on your investment committee and sit in the room when these decisions are made. And one of the things I've been impressed with is how many deals get to so close to the finish line that you decide at the end of the day just isn't going to fit the right profile.
Right.
Maybe just comment on the team you've put together to kind of help make those decisions.
Yeah, well, you being in an investment committee, you see the folks that I'm dealing with are all pretty studious when it comes to an investment, and we have all backgrounds: a partner at KPMG, an ex commercial lender, a businessman, one of our other investors. And so when you come to these meetings, we have a general plan of, from start to finish, if we acquire this building at this price and we hold it for 5 years, we think we can get this kind of debt. We show the whole thing from start to finish. Here's what we think this will make. And when you go to that committee, they say, well, have you talked to so-and-so in the market? Do you really think you can borrow at that? All the things that we've looked into, but they bring up good points. And a lot of times we'll go and say, you know what? Table it. We'll get back to you, and next quarter we'll look at it again, or in a month we'll have another call and we'll get back at it. Sometimes we can answer the question correctly, sometimes we can't. But I would say on average for every deal we do, we look at 50 deals. I mean, fully underwrite 50 deals. So that's how many deals we look at.
Right. Also on the, one of the reasons our clients love this asset class, one, the return profile can be attractive, but also it tends to be a less volatile asset class. And I realize part of that just comes from, more infrequent pricing, but, talk to me just a little bit about how you all, take a very conservative approach on, value in those companies, how frequently the properties, and how frequently the underlying portfolio gets valued. Because I know you've intentionally taken a conservative approach that likely results in a bigger number on the back end.
Right. Yeah. So we really are unique. One, we're SEC registered, so we get audited annually. All of our returns are audited returns, and they have to be. We actually got audited by SEC this year and passed everything with flying colors. It was our first actual SEC audit. So you got to be very careful when you look at returns for funds, because unless it's audited by a reputable firm, it's kind of all they really have to do is say, well, we think it's worth this. Okay, so this is what Bentley's getting at. So the way we look at assets is we literally, from year over year, it's valued at the equity we put in it the day we bought it. And the only change in that valuation is how much debt we pay off, unless there's a new appraisal done, and or there's a refinance, which you have to get a new appraisal to do a refinance. So, and that's the only time that valuation changes other than the payoff of debt. There is no I bought a 7 cap rate and I'm so much smarter than the rest of the planet. Now I think it's a 5 cap rate. Therefore, you have a 40% increase in value. We don't value that way.
Right.
So it's very easy to manipulate values of real estate based on the eye of the beholder. And there's none of that with our firm.
Let me ask one more question and we'll wrap up. I realize there's no, again, you don't have a crystal ball, and I know the documents in these strategies read a certain way, but in a typical cycle, how long do you think the fund life really is? Or let me rephrase it.
Yeah.
What do you think the time frame where a full return of capital would come, and then extending beyond that, maybe for that upside return?
Sure. So that's a great point. So we usually have a 1 year or an 18-month fundraising period. Over COVID, we did 18 months because you really couldn't meet with anyone for 6 months. But so from the end of the fundraising period, it's about an 18-month to 24-month period of time to invest the dollars. So the equity committed, we invest 80% of equity committed, and that's over an 18 to 24-month period of time. We have shown on our first fund and well on the way our second fund is we returned all that capital before about year 4 to year 4.5 gets returned back to the investors. So the way our funds work is we return 100% of the capital. You get a 7% preferred return on your money the entire time it's invested. So it behooves us to make sure we give your initial investment back as quickly as possible. I mean, that's just, people say, when are you going to distribute money? I say, anytime we have free money, we're going to distribute it, right? It just logically makes sense. And then the difference too is Bentley, you know this, is a lot of funds, the carried interest on funds is, the profit that we gain from being successful investing your people's monies. Ours is on the entire portfolio. So we will not make any of those dollars till the very end because we have to perform those returns on the entire portfolio of assets. It's not asset by asset. It's set up as a very, very investor friendly model. And you know this, I'm a very large investor in my own funds as well. So I want to treat the investors fairly.
We like the alignment. I know you heard us say that before, but across a lot of our strategies, one of the key things we're looking for is that the principals, the owners, have their money at stake in the same strategy. And as you know, we're investors as Team Navitor. We're in those deals too, so we love that.
Absolutely.
Well, you've been kind to spend a few minutes. I want to wrap up here in an effort to keep this as a digestible amount of information.
Good luck.
I can't thank you enough for your time and all the effort that you all put in on the strategy, and look forward to the new strategy rolling out later this year, next year. When's the next?
January.
Awesome.
January.
All right.
Yep.
You'll rejoin us maybe for an update later in the year.
I'll do it anytime.